So nice, got the recording going. Thanks, Brooke. Uh, so who the heck am I? Real quick here. Born and raised in Boulder, Colorado area. Still live there today. Really love soccer, skiing, being outdoors. Have an awesome little dog named Junebug, a daughter, and a wife who also works in the CPG space at Vital Farms. Her and I actually met at Justin's. So first gig out of college was at Justin's. Started out as an intern there. And over time, eventually ended up owning their full trade process and forecasting process. Joined when they were around 10 million in size. We sold that business to Hormel. And then I left about 6 months after we exited that company. Uh, During my time there, managed trade in Excel up until about 20 million in revenue. And then we ended up adopting a tool called AFS. That was my first experience with trade software. After that, jumped over to Perfect Bar, or now Perfect Snacks. Joined there when they were around 20 million in size again. Uh, Owned trade forecasting, sales strategy, those sorts of things. And we actually built Vividly while at Perfect Bar, kind of as our own custom software. Was doing everything in Excel again, was sick of doing it in Excel, didn't really find other systems out there that understood small, fast growing businesses. Like I would talk to them about the struggles of UNFI and KE, and these other companies would just kind of look at me with a blank stare and think like, we're used to working with Pepsi and Coca-Cola that are direct everywhere. And we just like weren't speaking the same language at all. Um, and then we sold that business to Mondelez. Then Nikki and I jumped over to Lily's and consulted on their trade and forecasting process and kind of helped them figure out this is how to manage deductions, how to think about trade, how to think about forecasting. And we were also then turning Vividly at the time Cressicor into kind of a side gig business. And at that point had expanded to 10 brands. Lily's sold to Hershey. So at this point, Nikki and I both had really kind of entered this pattern just through luck and working with incredible leaders in the space of jumping into these awesome, exciting, fast-growing startups and growing them quickly, and then selling them to strategics. After Lily sold, we kind of realized, hey, nights and weekends doing this whole trade software thing seems to be working. We've got about 10 companies we're working with. Let's go raise some money. So we raised a Series Seed in 2021, a Series A in 2022. Rest is history. Work with a little over 100 brands now, have about 80 team members. So Nikki and I kind of took this shift from working in CPG to now running a software company. So kind of an interesting transition. That's my background. So just jumping into first off, like why are we doing this? I think a lot of small companies and founders, I think rightfully so, get pretty jaded pretty quickly about trade in general. I think especially right now, there's obviously this trend that's occurring in the space where retailers and distributors are asking more and more and more of brands. I want you to spend 20%, 25%, 30% of your revenue. And it's just getting worse and worse. It's this reaction to inflation and prices going up on shelves and still having expectations of certain margins. And it's all just kind of falling back on the small brands and expecting them to spend more and more and more. But I think it's important to take a step back and remember, well, why are we doing this? Like, first off, there is a cost of doing business, right? Retailers and distributors have certain requirements. Oh, you want to work with us? Got to do this intro. Oh, you want to work with us? You got to give me slotting. I need you to do 4 deals a year. You have to participate in the ad, whatever it may be. So it's important to admit right up front, there is just a cost of doing business. But from there, building brand awareness, right? We want to bring new consumers into the brand. A lot of people out there don't know who we are. They don't know about our product. They haven't tried it. Well, trade promotion is a way to get them to try that out. Seeing your product for the first time in an ad, walking down the aisle and you are not on their grocery list, but they see the tag, it draws their eye and they say, that looks really good. I really want to try that out. And then as you grow and you start to get repeat consumers, there's also the aspect of trying to get them to buy more. When you're, tens of millions in size, one of the big aspects to your growth is somebody that buys, one chocolate bar a day. You want them to buy two chocolate bars a day, or you also want to come out with a product that is meant for their kids and you want them to start buying them for their kids, that sort of thing. So expanding basket size is kind of that weird industry term. The other one that's super obvious here is driving revenue, right? We want incremental sales. We want those incremental sales to turn into building and improving our baseline sales. Another one that you don't really even think about much is just the building relationships aspect with buyers and distributors. Signing up for those programs that they want you to do, and they're really eager to get brands to join in on, and creating that good relationship, showing that you want to invest and are prepared to invest in the success of your products on shelf. Every leader I've worked with would always say something along the lines of, to a salesperson that got a new win, they would say, "Hey, that's great, but now the real work begins. Can you stay on shelf? Can you gain category share? Can you become best friends with that buyer where they know their brand ships in full? Their brand has a logical trade spend strategy that works." And then competitive advantage overall. There's going to be the companies that are just kind of saying, "I'm going to do a 20% discount 4 times a year, and I don't know if it's working or not, but I'm just going to do that and forget about it." And then there's the ones that really think about things strategically, get into the weeds, make decisions based on data. And when you think of comparing those two companies and who's going to succeed in that category, the one that is maximizing the leverage of trade is going to have a competitive advantage. So I'll pause there. I see there's some stuff in the chat. Awesome. Eating a perfect bar now. I love that, Brooke. Um, I'll keep cruising through here. And I will mention, as I'm going through this and I'm talking through this, please feel free to raise your hand or jump into the chat, ask questions, or even if it's just a statement, share your challenges, share your experiences, whatever pains you're experiencing. We can totally go on different tangents, have conversations around those things. So please feel free to engage whenever you want. This isn't a, leave your questions to the end type structure at all. So the first thing for me is focus on the customers that make you famous. And I'm stealing this completely from the CEO at Justin's. I'll never forget that when he joined the company, he had he had a slide deck, and it was like 3 slides to the whole company. It was, "This is what our strategy is," and it was so simple. And the very first thing he talked about was customers that make you famous, and every single person in the company was supposed to know about this, who they are, and rally behind it. So what do I mean by this? It's all about ruthlessly ensuring that you are maximizing your spend with customers that are going to make you famous, and then minimizing spend elsewhere. And this goes not just for trade spend, but you think of shipping orders or revenue planning, where you want to basically put any bandwidth in the company towards. So an example of this from the trade spend side. So a general way of thinking about things is, my trade rate in Whole Foods is 18%. It's also 18% in all my other small retailers because I got the same trade calendar for everybody, and this is just what we're doing. Now, strategically, a more strategic way to look at things is I'm going to minimize spend in those smaller retailers, and I'm going to shift that spend into a customer that is going to make me famous, like a Whole Foods. Now, an important thing to note here is, for small brands, like Whole Foods might be years down the road. So the customer that's going to make you famous today might be Jimbo's, or you just broke into Natural Grocers or something like that. It totally depends on where you are at in your stage, but identifying who are the customers where I have the most growth opportunity with, whether it be distribution or because they just really churn velocity. They have so many people constantly in the stores. And I see 10 store chains that do more volume than a 100 store chain, right? So who are those customers that are going to make you famous? Really focus your trade spend there, filling orders there, and analyzing the spend there as well. So this also goes for post-promotional analysis. Being highly intentional and granular with those customers. And what I mean by this is, maybe those 3 customers that are really, really, really important to you, that you think are the key to your success, you're planning those promotions in detail. What do you think your lifts are going to be? How much am I going to spend? What do I think the ROI might be on this promotion? And then when those deductions come in, I'm going to go through that giant PDF that Kahi sends me, and I'm going to find those deductions that are for those key customers. And I'm going to see, did these deductions align with those promotions? How much did I actually spend? How did this promotion actually perform? And a way to actually have the bandwidth to do that, right, is those customers that you say are not going to make you famous, you put into buckets, intelligent buckets. As an example, maybe there's 5 retailers that you track in detail through UNFI, and then everything else you put into a UNFI bucket. You don't forget about it, but you just put into a bucket and say, I am expecting to spend 30 grand next month on UNFI all other on this product group. When deductions come in, they just go into that bucket. You don't get into the weeds at all because you need to spend your time on those key customers and really getting into the weeds there. So you can see how this is looking at how many hours do you have in the day and really trying to apply that 80-20 rule to how you manage that time. Going to pause here really quick and just see any questions, comments on this section about how to really focus. All right, we'll crank in here. Touched on this a little bit, but I think it's really important to think about this as you grow. So I mentioned that maybe today the customers that are going to make you famous are 10-store chains, but in 3 years, it might be Target for all you know. As you grow, you need to make sure that you are shifting who those customers are and how granular you are with certain customers. So I have a couple examples here. General, in 2020, I was in 5 retailers. I managed them all granular because I only have 5. It's not that tough to manage. In 2023, I have 20 retailers. So now I'm managing all with relative granularity. 2024, I'm in 60, but now I'm managing all of them at a high level because I'm in 60. There's a lot to manage. We want to avoid this. We want to, again, say, hey, instead, in 2024, when I'm in 60 retailers, I'm going to figure out what are my top 10, and I'm going to be extremely granular with those. And then the other 50, I'm going to manage those at a high level. Again, shifting that focus. And I see this all the time with brands that we work out with Vividly, where we work with brands that are just getting into their first store up to 500-600 million in revenue. And we'll talk to customers that are 100 million in revenue, and they're still trying to operate the way they did when they were a lot smaller. So examples, maybe in 22, you're planning detailed trade calendars, looking at every deduction for Nugget and Molly Stones and Mother's Market. And then 2024 rolls around and they're a lot bigger and they're still planning to these granular customers and they're saying, I don't have the time for anything. Well, of course you don't. You're still planning at this extremely granular level. As you grow, shift that. Another example with this that I see all the time is when you're first starting out and you're planning your business, you might be thinking at a DC level, my UNFI DCs, my KE DCs. But as you grow, that should change. You should not be a $20 million customer or $20 million brand, and you're having to be planning by DC level. Plan at a total UNFI level when it makes sense. Plan at a total KE level when it makes sense. A lot of what we do at Vividly when we are implementing customers is we're helping them shift out of old ways of doing things and shifting into scalable ways of doing things. When you have 30,000 doors, there's no way you're going to track every single promotion. There's no way you're going to be tracking every single DC. And if you are, you're just having analysis paralysis. And I guarantee that your time is better spent to really, really focus on those handful of big promotions that really mattered a lot than just blanket level, high level views of everything. So next, knowing the rules of the game, I think this one's tough because there are a lot of rules out there, and I feel like nobody tells you the rules, and you kind of have to figure them out as you go. So I think a lot of this is based on creating good relationships in the industry through networking. Everybody does want to help each other out. They really, really do. Leaning on your broker. If you feel like there are a bunch of unknowns happening, you should be really frustrated with your broker. They should be helping you understand exactly what types of fees you should be expecting, how their process works, the timing of different things. So I would really look at it from the perspective of, if I am constantly getting surprised by things and I do not have answers to things, I should be shopping around for another broker. Um, I think that that's really, really important. And a lot of these things are fast moving. There's constantly new fees that are occurring. I just saw that Sprouts has some new like ongoing fee that they just implemented at like 8% or something crazy like that. They should be telling you these things. Uh, I think it's really important to just read this. Effective trade strategy is grounded in fact-based decision making, ensuring it aligns with your growth plan. So what do I mean by that? Fact-based decision making. First off, I see a lot of brands where they'll forecast to their heart's end. I think this is how much we're going to do in revenue next year. This is how much I'm planning on spending in each of my key retailers. And then they do the next year and they forecast again. But if you're forecasting and then not actually seeing what happened, the forecasting is pointless. I think I'm going to spend $30,000 in Jimbos this year. Okay, how much did you actually spend? You should be able to know that answer. So then next year when you're planning, it's based on real data. And then ensuring it aligns with your growth plan. This is really important. If your growth plan is to grow as fast as you possibly can, then you have a certain trade strategy. If your plan is to be as profitable as possible as soon as possible, you have a different trade strategy. And both of those pathways are great. So really asking yourself, what are my goals as a business? And the way I think about trade then is it aligning with that? And that can be totally different for different retailers. Maybe you really want to grow a ton in one retailer, but another retailer you feel like, I don't know, they have a lot of fees. It's really difficult to operate there. I don't see them being an area for growth. I want to improve my margins there as much as possible. You have a different way of looking at things with them. A few examples here of knowing the rules of the game. So this first example, I think, is just a good standard one for how this can work with any retailer. So I want to run a 2 for $5 in Whole Foods. I think I'm going to sell 100,000 units. You have this question of, okay, well, how do I get to the 2 for $5? Am I going to do an OI and in UNFI and then an MCB within Whole Foods to get down to that price point? Or should I run a scan? There's all these different decisions to make. So many brands, when they think about trade strategy, they think about, should I do the 2 for $5 or the 2 for $4? What's my price elasticity? Like, how can I fine tune my ROI? Forget all of that. Like, the very first thing is, do I understand how trade functions with this certain retailer? And do I understand which type of trade I should be utilizing to have the most efficient program ran? So with this example, whether I run a scan or an MCB, I'm going to get hit with an $11,000 TPR fee, a 16-cent prime scan per unit in this example, a 2-cent scan fee per unit, which is funny to me, also on the MCB, even though it's called a scan fee. So an example of one of those little rules of the game that the broker should help you understand. If I run a scan, it's going to cost me 25 cents a unit. The scan is actually going to get charged 2 days before they even put up tags and 5 days after. So if I run a 2-week promotion, I'm going to get charged for 3 weeks. Another rule of the game that you can think of for, hey, my broker should be helping me understand this. I should be having these conversations with my buyers. So then when I plan my promotions, I'm not taken by surprise of, wait a minute, why did I get deductions for 3 weeks? This totally threw off my whole unit economics of what I thought this promotion would do. Now, the MCB, it's actually going to cost me 35 cents a unit, because with the MCB, I'm going to get hit with the absolute max markup that UNFI has. So, for example, let's say that Whole Foods' markup from UNFI is 6%. You are not going to get that MCB on the deduction at a 6% markup. They're going to choose the max markup that they give the smallest customer that they ship your product to. At my time at Perfect Bar, that was about 32%. So whatever I'm passing down to the retailer, they're going to mark that up 32%, and they're literally just going to pocket that money. I remember having to go to a meeting with Ahold and show them that you were making more money on marking up our MCBs than actually shipping our product to UNFI. So With this, there's a buy window for the MCB, a 4-week buy window. So just for making the decision of I am going to run a scan in Whole Foods to do my 2 for 5 versus I am going to run an MCB, it's $10,000 cheaper in this example to go the route of the scan. I guarantee you there is no fine tuning you could have done with this promotion to get an immediate, obvious $10,000 discount. So just really trying to stress here that just those basics of should I do the ad or should I not do the ad? Should I do a scanner and MCB? Those are really important decisions to make. Another one I always love to give, EDLPs. Should I have an EDLP or not? Well, I like to ask, if I run an EDLP, what are you going to do for me? In Sprouts, if I run an EDLP, they have a tag on the shelf and it looks like a promotion is running all the time. There's literally a tag to draw my eyes. In Whole Foods, if I'm giving them an EDLP, there's no tag. It just shows a lower price. I have no idea that it is a lower price than what there normally would be. So I've consistently seen a better reaction in terms of an improvement to my baseline in Sprouts than in Whole Foods. It's just a simple question. Oh, hey, I want to hit this price point. Okay, hey, you'd have to do an EDLP. Do you put a tag up to show that there's a price change that's occurring and there's always going to be a tag on shelf? Just that simple question can help you make a decision on, should I run the EDLP in this chain or in that chain? And then last example, another bigger retailer here, but just another example of how important these things are. Albertson, Safeway, SoCal. If I give them $1 in trade spend, they'll say, hey, I'll drop the price $1 on shelf. But if it's Albertson, Safeway, Intermountain, I say, hey, I'll give you $1. And they'll say, hey, I'll drop the price 80 cents. So of course, I'm going to go spend more in SoCal than I am in Intermountain because they're actually giving me penny for penny, and Intermountain's pocketing 20 cents for every dollar I give them, just padding their own margins. So those conversations with your buyer, those conversations with your broker to really understand what are all the fees, what are all the little bits and like what's in the weeds. So then when I paint the picture of where do I want to allocate money, it helps me make better decisions overall. Cool. All right. Just some high level suggestions here that I've seen, and I'll say that this is only based on the brands I've worked with. It can totally depend on different categories, products, so on and so forth. But depth of discount in general, we're small brands, we have thin margins, everybody's asking us for more and more money. I'm a big fan of basically trying to give as little of a percent discount on shelf as I can. My goal is to get a tag on the shelf, just a promoted tag to draw the eyes of the consumer. Especially if you are a premium product, the buyers, the consumers out there are not going to say, oh, I would buy their product if it was just 3% cheaper. Like, no, you're just trying to draw their eyes to the shelf. And also, if I have a lower depth of discount, it'll give me some more spend to do something like an ad or a display. Promoting in multiples, I also typically see this return a better ROI, a 10 for 10, a 2 for 5, those sorts of things. I think it's just a psychological thing where the consumer is just more likely to buy more of something if that's the deal structure. I don't know about you guys, but there's so many times where I'm at the grocery store and I'll see a 5 for 5 or something, and I'll kind of wonder, like, wait, do I have to buy 5 to get the discount, or can I just buy one? And I just end up buying 5 because I just like want to get the discount. And as the brand's like, hey, sweet, they just bought 5. They normally would have bought one if I just said, hey, the price point is $1 this week. So promoting in multiples, I think just psychologically is typically a good idea. I mentioned ads and displays lightly with depth of discount. I would say that this is one to be really careful of because ads and displays can be really, really powerful, but they can also totally destroy your trade budget. Um, an ad or display is really, really helpful for small brands, particularly because the vast majority of consumers don't know who you are. You aren't on their shopping list, right? It's not like they're going to the store and they're looking at their phone at their shopping list and they're like, oh yeah, I need to get this product. You want to catch them off guard. You want to get added to their shopping list and not, even though you weren't part of their normal weekly grocery trip. An ad or display really helps that happen. You walk into the store and there's that pretty display. Oh, I didn't know that I needed the new rosé flavor of Waterloo, but now I really want it. That just happened to me a week ago in Whole Foods. It was like front and center right there. It's like, oh my God, I have to buy this. This is great. Uh, or an ad, right? You're flipping through the ad, and I'm seeing all these brands in like the Natural Grocers anniversary ad, and there's all these brands with like these super deep discounts, and I'm thinking like, wow, I got to go to the store and do a big shopping trip because there's so many discounts. And then I see on there, there's one brand that is also in the ad, also getting the same real estate on the page, and they're only giving a 10% discount. But now I'm looking at their product, I can see a picture of it, and I think, God, chocolate truffles sounds so good. I might put that on the list, even though I had no intention of buying that originally. However, these can cost a lot of money, and I see them range greatly from retailer to retailer. You could run a promotion in a small retailer and get $200 in incremental revenue from it, and the display costs $1,000 or something. So don't just go out here and now and sign up for every ad and display. Like, be really intentional about it. Who are those customers that are going to make you famous? What are their different ad fees? Who has the cheapest ad? Who has the cheapest display? Or maybe a give and a get. Hey, if you take on this new flavor of mine, I will sign up for 2 displays next year. Those sorts of things. Show that you're willing to commit to the success of gained distribution or new items on shelf with these types of levers. Running experiments is really important as well. I'd say this might be a bit more of a luxury sometimes early on, but as you grow, let's say that you've been in a retailer for a handful of years, start running experiments. If you're running a 2 for 4, 4 times a year, and it's just you've done it a few times, try a 2 for 5. Try an ad with it, try a display with it, run little examples, and then just go back, spend a few hours in an Excel table and just see like, hey, was that ad worth it? Was the display worth it? How did that price point work? Just by running a few experiments over a couple of years, it's crazy how much it can actually hone you in on a much smarter trade strategy. Really deciding what actually is the right price point. Is the ad actually worth it? Is the display better than the ad? Those sorts of things. So play around with things a bit, run little experiments, but also talk to your buyer, talk to your broker. They should have also ran experiments in the past. They should also be able to give you guidance on this is what I've seen work with other brands in the category that I'd worked with in other retailers, that sort of thing. I mean, everybody in the ecosystem wants you to succeed. The buyer wants you to do well. Your broker wants you to do well. Everybody makes more money. So ask these questions. And then we touched on this, with the previous slide with the scan and MCB example in Whole Foods, but I'll just say it again. Types of trade really matter. I said it a bunch because it really matters that much. I see so many companies just do MCBs and don't really think about why, or they'll sign up for the OIs and don't really know what it means. Be really intentional about those types of trade. So short-term versus long-term ROI. I don't know if any of you have tried to kind of calculate the ROI of one of your promotions or not, but vast majority of the time, it's not going to look good. It's probably going to be a negative ROI. You're probably losing money on that promotion. But there's more to the story there. So on the left here is an example of maybe looking at things in a short-term view. I ran a 2 for 4 in Sprouts. There was a scan and an ad. I determined, I think I had about a 50% lift. I had 20,000 incremental units. I have a margin of 50% and the deductions came in. The promotion actually cost me 20 grand. And I just want to pause here and mention, just to go back to the customers that make us famous slide, don't do this with every promotion. Don't do this with every retailer. Like, hone in on like, what are the 5 promotions I'm going to do this with to like really understand? Because you've got tons of other things going on, right? There's a million things a founder has to do in a small CPG company. So do it in small bits. But here I'm really determining, okay, my product margin dollars is $10,000. My profit, because actuals came in at 20,000, was negative 10,000. I lost $10,000 on this promotion. And so my ROI was negative 50%. Oh my gosh, I'm never going to run this promotion again. Why did I do this? Well, there might be more to the story. On the right side, think about hey, okay, I sold 20,000 incremental units. Let's say that half of these were from brand new consumers. They've never tried my product before. And let's say half of those said, I really love this product. I'm going to buy it every single month now. That perfect bar is going to be part of my breakfast once a month. Well, now you go through these calculation steps and think, well, if 10,000 or if 50% of those 20,000 units were new, that's 10,000. 50% of those are repeat buyers is 5,000. I'm now selling 5,000 more units each month in future months. After 4 months, this promotion is actually a positive ROI. So I I'm not saying you should go and figure out what percent of my incremental units were new consumers. What percent of those are repeat buyers? That's for larger CPG companies to pay big dollars to figure out what those are. Don't go do the calculations on the right side. The point of this slide is just for you to understand that there's more to the story. We're doing this for a long-term reason. And even though in the short term, these promotions are probably not providing a positive revenue output, in the long term, they might be. And so our goal here is to have a positive outlook on that long term. Any questions on this piece? Okay, cool. I'll keep cranking. And please feel free to jump in at any point. Thanks so much, Maureen. Uh, Deductions. So everybody's probably immediately thinking, oh my God, I hate deductions. I feel the exact same way. Deductions, honestly, make me really nervous. I'm not an accountant. I think they're absolutely crazy with the way the whole industry runs, and that you get these giant PDF reports, and it all feels a little rigged in a way, just to be completely honest. But this is the way the industry works. We have to play by the rules of the game that there are today. So, just a few thoughts on some advice here. So, understanding your flat rate and percentage deductions, swell allowances, terms. You got a 2% fee for KE Connect. You got a 2.5% SSA fee now with UNFI that's brand new. Just knowing these basics, like what is in my contract with UNFI, what is in my contract with KE, knowing exactly what those are and projecting spend from those for those is really, really important. I usually see brands be most taken aback by these types of things in terms of blowing up their cash flow versus running a promotion and it performing differently than what they thought it was. It's completely missing the fact that the terms are actually X, your swell allowances are actually Y. So just getting some of these basic flat rate deductions down is really important. And again, the proper communication with buyers, detailed communication with brokers, these types of things should be boiling up. If you're taken aback by one of these and you're surprised by one of these, have that conversation with your broker. Why did I not know about this? What else do I not know about? Let's go review the contract together and map these things out. Next one, analyzing non-trade deductions is really important. So I'm sure you guys all hear about and think about disputing deductions. It's a huge, huge aspect of what Vividly does. We, on average, are disputing around 14% of a brand's total trade spend, and are successfully disputing about 75% of those. So let's say, just rough math here, like 10% of all of your trade spend is actually probably not legit. Like you should be able to fight that and win it. It's crazy that that's the way it is, but it is the way it is. However, like 90% of that is actually non-trade. So what I mean by non-trade, late fees, shortage fees, lumper fees, invoice adjustments. So having things together like your proof of delivery, your bill of lading, having those photos, having those signatures is going to do wonders for you. You're going to win back so much money. When you get hit with that deduction, like, hey, you short shipped us on this, or we never received that. Hey, no, here's the POD, here's the BOL, I have my evidence. We see brands constantly, successfully, every single week win back those deductions. So if there's any place to focus when it comes to disputing, it is in this area. Again, your broker should help you out with that. As you grow, I'd say when you're getting into the $5-10 million size, start thinking about hiring somebody that really knows this stuff and can get into the weeds with it and can be that trade manager slash sales analyst slash accounting AR analyst and wear all those hats and fight these types of fights, because they can probably pay for themselves just through getting these disputes back. Also, a lot of companies will outsource this type of work. A year ago, we launched a service at Vividly, totally separate from our software, where we reconcile deductions, we pull back up, we dispute. And just in a year, we now work with over 50 brands doing all their deductions for them. So if it's one of those things too, where you're like, I don't have the time for this, I can't hire somebody, start Googling, do some research. Don't just look at Vividly, look at a bunch of different options. There are things out there to help you. On the right side, this is a bit more about process with deduction management. So there's this thing that we've used at Justin's, Perfect Bar, and Lily's. Sales always hated it, but it was super, super important for finance and accounting, is a mislog. So what the heck is a mislog? Basically, when deductions come in for those key retailers that you are tracking, that you've determined these make me famous as a business, when deductions come in and they don't make sense to you, or there is not a promotion that you have planned within some sort of Excel tracker, that should go into a mislog saying, hey, sales, either we forgot to plan this promotion in our system, and so we didn't accrue spend for this, or this might not be legit and we're going to go dispute this. And you should be meeting with each other, let's say maybe on a monthly basis, and figuring out what are those core deductions, what are those big spends that are in the mislog that we think seem a bit funky. Let's review them as a team. Let's talk to the broker. Let's figure out if there's a contract or not. And first figure out, is this legit? If it is, then why did we not plan this? Let's go create that promotion. Let's make sure future promotions are also in there. Or if you, the broker, everybody says, I don't really know what this is, go dispute the thing. This is how you hone in on what you can dispute, but it's also how you minimize unplanned spend. I think of a time at Justin's when we were dealing in peanuts and almonds. We were super reliant on those commodities, and the price of almonds was just skyrocketing because there was a drought in California and our margins were just getting destroyed. And when all this was happening, we got an $80,000 deduction for a Kroger promotion that we didn't plan, and it was legit. And it totally screwed us for a month. It totally wreaked havoc on our cash flow. And it was just because we missed planning that promotion and making sure we had enough money in the bank for it. So this is one of those key aspects of a process to track these things ahead of time. Usually what we see is the mislog starts this big, and then it goes here and here and here and here. And then because each month you're noticing, oh, I didn't plan that. That's also occurring in these next 3 months. I got to go enter those as well in this tracker of ours and maybe this table in Excel. So I know that these spends are coming up. I know that we're going to receive these deductions. And then you hone in smaller and smaller and smaller on what you're missing. And then last, monthly cross-functional review. So, for some of you, might be small enough to where you're thinking, what do you mean cross-functional? I don't have accounting and sales. There's just me. That's fine. If it's just you, just have this, take the time on your calendar to have this meeting yourself. But in general, this is all about making sure that sales and accounting are talking to each other and are always on the same page. That person processing POs and going through deductions and whatever it may be, and that salesperson out on the road slinging deals left and right and trying to get you into more stores, they should have a monthly meeting. They're going through the mislog. They're figuring out, they're saying, what are we openly disputing right now? And what's the progress? Why is it not progressing? Do we need to submit it again? Do we need to follow up? Do I need a contract? Do I need additional evidence? Should I bring in the broker? The other aspect of this, which is a bit more fun, is, hey, what promotions did we run last quarter? What were the big ones that we decided to actually track, because those are the customers that are going to make us famous? How did they actualize? I thought that promotion was going to cost $5,000. It actually cost $4,000. How much lift do we think we got? Was it a good promotion or not? Maybe do that for like 5 promotions. Don't make it crazy, but actually look at some of them and just have it be the highest spend promotions. Maybe you're thinking, oh, I decided to run an ad, last week in Gelson's. Like, I want to write this down on my to-do list that 3 months from now, when all the deductions are finally received, we should really figure out how much did that Gelson's promotion actually cost? What did we see in terms of a change in how they ordered within maybe the UNFI data, or if you got some spins data, looking at that and really honing in on that deal and seeing how it performed. High level trade rate review. How much did we get in revenue? How much did we spend in trade? What's that percentage? Is that around what we're budgeting for, what we want to do? Anything catching us off guard? And then missing contracts. I would say that for those customers that make you famous, in my opinion, an important KPI to have as a team is every key promotion has a contract attached to it, like an audit passing contract. Like if you want to go dispute something and UNFI says, well, send me the paperwork, send me the contract, or Whole Foods does, or whoever, you have that on hand. If that is on hand attached to each promotion, maybe in a hyperlink in your Excel tracker, it's so much easier to validate the deductions and to dispute things if it's just available, instead of my Excel docs over here and the contracts are, in Steve's email, or it's in this giant Google Drive and I have to try to go find it and I don't know what the latest version was. Be really diligent about this. Let's see here. So getting into the pros and cons of things, before we jump into this, I kind of just want to pause and just see if there's questions, do a bit of Q&A here. If we have additional time, I'm more than happy to get into these. I'll just show you really quickly. There's a scan section, MCB, OI. I don't want to sit here and read these to you. You guys can read, but I am more than happy to cover some of these at a high level. But I suggest looking at these after the call. I'm sure we'll send the deck and just use these as a cheat sheet. This is a sum of the thoughts of like 30 different trade managers coming together and saying, what do I like about scans? What do I not like about scans? When do they make sense? When do they not make sense? To help you all make better decisions. So I'll pause here. Questions, comments, complaints. Love to hear from y'all.
Thanks, Stu. And yeah, anyone feel free to come off mute, jump in. You can keep it broad or even specific with your brand.
Sure, I have a question. At what point does it make sense to enact a software like Vividly? Like what level of revenue spend or like door count or just I'm not sure I'm understanding where that would make sense.
Yeah, great question. In my opinion, it's around the $5 million revenue size. I think that if you are smaller than 5 million in revenue, Excel and Google Sheets and Google Docs is awesome. And if you put together a clear tracker and you have a diligent process around when do we update it and who can have access and what's the format and all of that, that stuff's great. Excel, Google Sheets, it's super, super powerful. And I'm not going to sit here and say, hey, you should go, sign up with Vividly and spend this money for this system. Another way I like to look at it is if you're going to sign up for some sort of software like a Vividly, I would look at it in terms of what's the cost of it and how much am I spending in trade. And if the cost of the tool is more than a couple percent of your total trade budget, I kind of think the ratio is a bit weird. If I'm spending $100,000 in trade and the system costs 50 grand, whoa, like what the heck am I doing there? But if it's, the system costs 30 grand and I'm spending $3 million in trade, well, gosh, I'm spending 30 grand to make the other 3 million way more efficient, way more accurate, way more detailed, so I can make better decisions. Now it starts to make a lot of sense.
Awesome. Thank you. I have one more
great question.
So
Yeah.
we've been primarily D2C and we've been expanding into retail. We're not quite at that level, I would say, but trying to maximize what we do with our expansion. We're primarily in CVS. We've expanded to 4,000 stores. And the trade spend thing is very confusing from a D2C perspective mind. But I would love to understand because I don't know too many other retailers besides CVS. I feel like CVS has been a nightmare. They're just confusing as heck and all their different portals that they have for like disputes and anything and all, differentiating portals. I just feel like there's like 5 different portals. Do you have any recommendations on like how to handle CVS or any tips or insight on CVS and in particular with disputes? I have not been the best at navigating the dispute system, and I just have noticed a pattern of illegitimate charges. So I've been trying to figure out how to dispute those. And if
Yeah.
there's a timeline, it seems like there's like a 90-day window, and we discovered like a whole bunch just because I just have too many hats and our team is small. So we discovered a whole bunch of stuff like 6 months later, and it seems like we don't have any rights to disputing that. Is that correct?
Yeah, it's really important for everybody here. Different retailers and distributors will have a window of time in which you are allowed to challenge certain things. And that's another thing to know really well in terms of how to think about focusing your time. I think UNFI is like 2 years. I think CVS is really short. It's something like 90 days.
Yeah. That's what I
It's
discovered, and I didn't know that.
yeah, it's crazy to me, but that's the case, but they're able to get away with it. Um, I think so. First off, you are not alone. CVS is very much known as one of the more difficult ones to manage, uh, where people feel like they're getting the most fleeced. Uh, I would say that from what I've learned, it seems like a lot of the things that are causing pain and struggle are kind of in the fine print of contracts, agreements, that sort of thing with them. Um, we actually recently put together a few slides for a customer of ours that was particularly having a lot of pain with CVS. I would love if maybe after the call, I can get your contact information through Brooke and I can just send you what we sent these folks. We have a team of people to dispute, and they gave notes on CVS of their experiences with disputing, what works, what doesn't, pains they've been having, those sorts of things. So I can share just direct feedback from the team on how to think about CVS.
Yeah, I would love to. And I have definitely noticed a pattern in the entrepreneur community that I've talked to with people with CVS. Like there's some systemic stuff that is questionable. So yeah, I'd love to figure out how to navigate it.
Yeah, and it'll just get worse as you grow and you're spending more and more. I was just talking
Yeah.
to like a $200 million company, and their entire purpose of talking to us was, we think we're getting fleeced from CVS, and we have a giant team of people that are looking at all this, but we can't figure out exactly what's going on. And they have a giant team of people. So yeah, it's crazy the way it is. But I think making the right connections with people, having the right relationships, and I would ask Maureen, if you have a broker that is helping with the relationship of CVS, uh, I would be probably asking a lot more of them and demanding more in these types of areas.
Yeah, I think that's the other reality I've come to listening to you is we probably need to figure out our broker situation better. We have a broker. I just don't see much happening there. So yeah.
Sure. And I'll say, everybody, that like there's a lot of brokers out there, and they fight tooth and nail for your business, and you should have extremely high expectations. Uh, we one of our partnerships is with CA Fortune, which is a brokerage firm we particularly really like. But it is surprising, I think, the variance in the type of experience you can have with brokers where you just might not be top of mind for them. Go find one that where you are top of mind for them, right? Hearing that, you just figured out there was this 90-day thing. I feel like that's table stakes. Hey, we're signing up with CVS. Heads up, you have 90 days to review this information. So let's be diligent about this, and let's start a process around reviewing this together on a monthly basis, right? Like that's the way that's the expectations I would be having. I mean, they're taking a couple of % of your revenue on every order, make them earn it.
Thank you. Yep, that makes sense.
Maureen and others too in the chat. I put Stu's email and LinkedIn so you can stay connected. And then I'll put my email too if y'all need anything or you want the recording. I popped the deck in the chat and you can go ahead and grab that now if you want. But again, just let me know if you need anything or how we can support you. Good
Awesome.
question. I think we might have time for one more question.
Any other questions? All right, well, I definitely say check out the deck, spend the time, just grab 15 minutes and go through those pros and cons of scans, MCBs, and OIs. And when you are signing up for additional programs in the future, jump back to that cheat sheet and really ask yourself, like, am I taking advantage of the pros? Am I avoiding the cons? I'll say that at a very high level, generally, I find scans to be better. And I find trying to avoid OIs at all costs is probably a good thing. I was just talking to the founder of a new company called Fishwife. The founder was the founder of Petite Pot. And which I don't know if you've tried Petite Pot, but it's a really, really tasty product. And I was having a conversation with him, and the first thing that he said about starting this new company was, I'm avoiding every single OI. I'm doing no OIs anywhere. It's my policy. So you can see how like a founder starts a company, has all these experiences, and then now that they get a second shot, the types of decisions they make. Nice to meet y'all, and thanks for jumping on and taking the time.
Yeah, thanks everyone. And thanks so much, Stu, for all of that. I mean, you did such a great job covering everything in such a short amount of time. So again, let us know if you need anything else, founders. And thank you, and everyone have an amazing weekend. We'll see you next time. Bye,
Bye,
y'all.
everybody.
Thank you. Bye, Stu.